Today we're tackling a really interesting question. In a tight economy, why do some businesses get the loans they need, while others, who are willing to pay the very same price, just get turned away? Let's dive in.
When you're looking for a loan, you'd think it all comes down to the interest rate you're willing to pay, right? But what if that's not the whole story? What if getting that funding is less like an auction and more like trying to get into some kind of exclusive club? The truth is, in today's credit market, there's a hidden pecking order. And where you land in that order, well, that determines if you get funded at all. So this brings us to a really fundamental puzzle. In most markets, if demand is sky high, the price just goes up until things balance out. So why don't banks just keep raising interest rates on loans until supply finally meets demand? Well, the answer is this phenomenon called credit rationing. And this isn't about credit just being too expensive. No, this is about credit being completely unavailable to some people, no matter the price. It's what happens when banks decide it's actually more profitable for them to just say no to certain borrowers, rather than charge them a higher rate.
Okay, this slide really gets to the heart of why credit is just different. See, in a normal market, a higher price filters out demand. Simple. But in the credit market, a higher interest rate can actually do the exact opposite. It can attract riskier borrowers. It's a concept called adverse selection. The safest borrowers, the ones with the really solid projects, they're the first to walk away as rates climb. The ones left are often the ones willing to take a big gamble, which of course increases the bank's chance of a default and can actually lower its expected profit.
So if just jacking up the interest rate isn't the answer, how do banks decide? This is where that modern hierarchy really comes into play. It's a decision process that's based on two really powerful structural filters that have a massive impact on entrepreneurs and small businesses. And the first filter might surprise you. It's not really about the borrower at all. It's about the bank's own balance sheet. Specifically, it's about the very strict regulatory capital rules that you might know as Basel III. So here's how it works. Under these rules, every single loan a bank makes uses up a certain amount of its own precious capital. But, and this is the key, not all loans use up the same amount. Regulators assign what's called a risk weight to different types of loans. So, a loan to an unrated company, for instance, is 5 times more capital intensive for that bank than a prime residential mortgage. That means a bank is always going to prefer to make the most capital-efficient loan it can. And this number right here, this illustrates the very top of that pecking order perfectly. A loan to a top-rated government has a risk weight of 0%. 0. It requires no capital backing from the bank at all. It is, by definition, the most efficient and therefore the absolute most desirable loan a bank can make, especially when capital is tight. All right, so that's filter one. Now for the second piece of the puzzle. The powerful preference banks have for their existing customers over new ones. And this isn't just about being friendly. It's a cold, hard calculation based on information. Just think about it. If a bank has a long-term relationship with you, they have years of data, a proven repayment history, a deep understanding of your business. That's private information that dramatically cuts down on their uncertainty. For a new borrower, especially a brand new business, all of that information has to be generated from scratch, and that is both expensive and risky for the lender. So this informational advantage leads to this pretty common banking strategy. First, you capture a new client, maybe with a really attractive, lower-than-market interest rate. Then, once that relationship is established and the bank has all that private info, it can start to extract higher profits over time because it knows the customer is now kind of locked in by how expensive it is to switch to another lender. And you can actually see this playing out in the data. That capture phase is very real. On average, a business that switches to a new bank gets an interest rate that is 32 basis points lower. That's about 1/3 of a percentage point than if they had just renewed with their old bank. That's the hook. But here's the catch. Here's the friction that creates that lock-in. A small business might face nearly $7,000 in extra upfront closing costs just to move to a new lender. These costs create a really powerful reason to just stay put, even if your current bank starts to slowly raise your rates over time. So when we combine these two filters, capital efficiency on one hand and relationship bias on the other, a very clear picture starts to emerge. A 4-tiered hierarchy that really dictates who gets funded, especially when times get tough. Right at the top, in Tier 1, you've got the strategic insiders. Think legacy relationships, super prime borrowers. They get unrestricted access. Below them, Tier 2, are the established, resilient corporations. They'll get consistent access, but it's a bit more sensitive to the economy. Now, Tier 3, this is where the rationing really starts to bite. These are the informationally opaque,
small businesses, new companies, firms without a long credit history. Their loans are capital inefficient and they're costly to underwrite. Their access to credit? It pretty much depends entirely on whether the bank has excess capital to spare. And finally, at the bottom, Tier 4 are the marginal borrowers who are just actively denied credit.
So why does all this matter? Well, because when a downturn hits and banks have to pull back on their lending, they don't do it by raising rates for everybody. They do it by systematically cutting off the bottom tiers. The first to lose access are the small and micro enterprises, the new players in the market, the businesses that don't have hard collateral or a long track record. They get rationed right out of the market, which can starve a growing part of the economy of the capital it absolutely needs to survive.
So the crucial takeaway here is this. Bank lending isn't a simple auction where the highest bidder always wins. It's a complex portfolio strategy, a really careful balancing act of regulatory rules, information costs, and long-term relationships. And understanding which tier you fall into, that's really the key to understanding your access to capital.